If you know me well, you know I'm very critical of many of the pro-IUL, anti-Roth IRA rhetoric that comes out of TikTok. It presents IUL as a one-size-fits-all financial instrument that ignores all of the other massive tax-free benefits within the IRS tax code. Recently, I saw a Twitter post where the poster attempted to take down a pro-IUL TikTok video for, among other things, comparing the IUL's fees favorably with those of the Roth IRA. Not only did the poster take exception to the video, but nearly everyone in the comments section did as well. "My blood pressure can only take so much," came one response. Her compliance officer, once he heard comments about fees being the same as a 401k, came another response with an attendant meme. "Her mind is going to be blown when she finds out about a brokerage account," claimed another poster. Were the Twitter posters justified in their derision of this video, or was there some truth to their criticism? That's what I'll be discussing in today's video. Okay, let's start off taking a look at this video. By the way, there is obvious puffery in this video that is not central to its overall message, so see if you can focus on the message and not the distractions of this particular IUL influencer's shtick.
Traditional life insurance is not the end all. My clothes have been smelling weird. I don't know, better. Traditional life insurance is not the end all be all. So what do I mean by traditional life insurance? I mean the life insurance you get through your job, the life insurance that's good for 10, 20, 30 years. It's very temporary, very cheap. It's great to have, but there's so much more to it.
She's simply making the point that term insurance plays a role in a financial plan, but it doesn't necessarily fit every context. I think I can get on board with this statement. Nothing scandalous or objectionable here unless you're a dyed-in-the-wool term-only advocate. Let's keep going.
You also need to understand that life insurance can be used while you're alive by using permanent life insurance, purchasing a death benefit, and then getting access to a cash value segment.
Nothing objectionable here either. Permanent life insurance does indeed have a cash value, which does afford you living benefits. For example, you can take tax-free and cost-free loans against your cash value as a supplement to other tax-free streams of income, such as Roth IRAs, Roth 401ks, and Roth conversions. Let's keep going.
The finance bros are going to be so mad at this one. If a permanent policy is structured correctly, the cash value in there will compound, and you can use it. Here's the cool part. You know how you have to wait until you're 59 and a half to access your retirement, like 401k, Roth IRA and stuff? Not the case in life insurance. But why would you want to touch your money before 59 and a half, everybody says? I don't know, to start a business, to purchase real estate, to send your kids to college, to retire. But your clients shouldn't be touching their retirement money before retirement time, everybody says. Why does the government get to decide that 59 and a half is retirement age for you? Aren't you tired of being told what to do? If there's a way for me to have life insurance, grow my money away from Uncle Sam, and access it before I'm pretty much done with life, I'm going to take advantage of it.
Okay, you may not agree with how she's saying it, but the substance of what she's saying is true, and there's no arguing it. If you have cash value in your permanent life insurance policy, you can access that money by way of tax-free and cost-free loans prior to age 59 and a half for the purpose of spending it on pretty much whatever you want. To me, the most practical application of this approach would be if you wanted to retire at, say, age 55, and you needed a bridge to tide you over until your other qualified plans became available at age 59 and a half. So yes, what she's saying here is accurate, Twitter snarkiness notwithstanding.
Yes, there are fees in life insurance, but they're no more than the fees in your 401k, Roth IRA, or other accounts you're using or paying to be managed.
Now, this is a pretty controversial statement, but only if you're not very good at math. The fees in an IUL compare favorably with what you might see in a traditional retirement account. The IUL's fees are higher in the early years, but they're much lower in the later years. And when you average them out over the life of the program, they can cost you less than 0.5% of your cash value per year. That's equal to or less than some of the most cost-effective 401ks in the marketplace. So a controversial statement sure to inflame the Twitterverse, but nonetheless true.
And while we're on that subject, yes, I work on commission, but everybody in the finance industry has to get paid, including me. Someone told me that you should never trust somebody on commission, which makes no sense because you'd never buy a house, you'd never buy a car, you'd never have financial products and services. Don't be silly.
I couldn't agree with her more, actually. Products and services shouldn't be evaluated on the basis of how the person selling it gets paid. Products and services should be evaluated on their own merits. That's one of the reasons why I've done as many videos on the merits of Indexed Universal Life as I have. Simply put, the IUL has qualities and attributes that allow it to accomplish things that no other tax-free tool can accomplish. Here are 3 that I frequently mention. First, you can receive your death benefit in advance of your death for the purpose of paying for long-term care, and should you die peacefully in your sleep 30 years from now, never having needed long-term care, someone's still getting a death benefit. Probably your kids or your grandkids, so there isn't that sensation of having paid for something you hope you never have to use. According to a recent Wall Street Journal article, these types of hybrid life insurance policies are how most people these days go about mitigating the long-term care risk. Second, the IUL works as a great volatility shield. If you can build up at least 3 years worth of living expenses in your IUL prior to retirement, you can use that cash value to fund your lifestyle in the years following a down year in your stock portfolio. By doing so, you give your portfolio a chance to recover before taking further distributions. This enables you to virtually double the sustainable distribution rate from your retirement assets to as high as 8% per year. You can't do that with any other retirement tool. Lastly, the IUL functions as an excellent bond alternative. If you were to simply reach into your retirement portfolio, remove the bonds, and replace them with IUL, you'd increase your return, lower your risk, lower the standard deviation of your entire portfolio, and experience a better outcome over time. There's no better bond alternative in the marketplace. In short, I don't think I heard this particular TikToker suggest, at least in this video, that the IUL is a silver bullet or panacea, which is frankly one of the unsavory themes I hear in a lot of these TikTok videos. If we take all of her statements at face value, what she said in this video is 100% accurate, and I defy any of the haters on Twitter to demonstrate otherwise. I think the rabid, unhinged, anti-permanent life insurance contingent on social media is so accustomed to reflexively condemning every pro-IUL message they hear on TikTok that they unwittingly attempted to debunk a video that just so happened to be 100% true. Now, as a reminder, notwithstanding all the pro-IUL benefits trumpeted in this TikTok video, that should not give anyone license to hold out the IUL as the only tax-free alternative you should be considering. The IUL only really works as a complement to other tax-free instruments such as Roth IRAs, Roth 401ks, and Roth conversions as part of a balanced, comprehensive approach to tax-free retirement. By the way, if you want confirmation that the IUL's fees do in fact compare favorably with traditional investment accounts like Roth IRAs, take a look at this video I created that arrives at precisely that conclusion. Folks, in the next 10 years, I'm looking to put 100,000 Americans on the road to the 0% tax bracket. If you'd like some help getting on the road to a tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.